Welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in.
Greetings, everyone. Welcome to the Q2 market update with Arbor Digital. Before we go into the market update, the team got together and wanted to do something special for you if you're tuning in or listening. Now, Arbor Digital is so much more than just an investment solution. It's a full service digital asset offering powered by an entire team. So to kick this market update off, we thought it'd be nice for everyone to meet the team that powers Arbor Digital. I'll start. So my name, for those of you who haven't heard or seen any of the content that I've done, is Marc Nichols. And if you are a current client, you've probably heard a lot of the stuff that I've done around educational pieces or informational webinars, and maybe even attended an in-person event on digital assets that we do on a quarterly basis for a lot of our clients. You may have also been on a business planning call or investment planning call that we do with all of our clients to ensure that everything is buttoned up when people onboard and we service them for the future. Now, the last thing I'll say is one of the many hats that I wear here at Arbor Digital is that I am behind the scenes helping build and maintain a lot of the processes powering our investment management of the portfolios, as well as our research and analysis. So if you aren't a client, then be sure to give us a ring so that way we can fix that. With that, I'd like to bring on Michelle.
Hey guys, as Marc said, my name is Michelle Kitta, and I obviously work for Arbor Digital. We value safety and security. It is a top priority for us, and not just for ourselves, but also for our partners and clients. In today's world, you hear a lot of common words that get thrown around, such as breaches, ransomware, viruses, malware, and they all sound awful, and they are. And a lot of times they're associated specifically with the digital asset environment. However, these particular issues, they're not just because of digital assets. It's an everyday, every workday thing that we all face. With Arbor Digital, my job is to direct our security efforts behind the scenes. We address these issues proactively. If you access any of our platforms, you use our communication channels, or even just share information with us, we take the security of your information and trust as one of our top priorities. Basically, I wake up and work hard every day for Arbor Digital so that we continue to earn your trust and business. And the next person that I'd like to introduce also assists with me in that in his own special way. Kirbykins, you're up.
Oh, you threw me for a loop there. Hi, everybody. My name is Kirby. I've been part of the Arbor Digital team from the beginning, before it was an actual thing, when it was more of just thought or an idea. Like many others here, I'm also part of the Many Hats Club. I help in the back end with portfolio construction, trading, rebalancing, etc. I also work with end clients, kind of explaining the pros and cons to this vehicle, the SMA vehicle, to some of the other more traditional vehicles out there, or high barrier to entry, hedge fundy type things, or some of the premium or just kind of trusts that are out there. On some occasions, you might also see me in some of our educational materials or channels that we put out there. With that, I will pass it over to Susan.
Hi, everyone. My name is Susan Liang, and I am part of the client service team. You will most likely see or hear from me when you have any service needs, meaning if you're opening a new account, if you're moving money, or if you have any general service items. I also work on building and refining our operational processes to ensure that clients have the smoothest experience possible. Next up, we have Matthew Kolesky.
Thanks, Susan. Yeah, my name is Matthew Kolesky, and I, like everybody here, wear a lot of hats. So I serve as president of Arbor Capital, as well as the chief compliance officer. And Arbor Capital is the parent company for Arbor Digital. And then Michelle also supports me in our compliance efforts. Kirby mentioned this, the genesis of Arbor Digital goes back to 2018, where we introduced Bitcoin to some of our clients. And fast forward to today, where we now have a full service SMA that is national, and we also serve individual clients. I also join Mark when he invites me. No, I'm just teasing. When on a lot of the updates, you'll hear from us later today, as well as around the community in Planner DAO and some of these other organizations that we're heavily involved with. And with that, I'll turn it over to Heather Dodson, aka Captain Obvious.
Thank you. I am Heather Dodson. I'm based out of Fairbanks, Alaska. I'm the director of client relations and operations. One of my main priorities is making sure that all of our clients are being taken care of and feeling special and all the oogie boogies. On the Arbor Digital sides, I'm more behind the scenes supporting the team and whatever else needs to get done.
Well, thank you, everyone. And I hope this gives you a little more insight into the people behind the solution. All righty, everyone. I hope you enjoyed meeting the team. Now let's dive right into the digital asset market update for Q2 2022. Now, before diving in, it's important that we go over some disclosures and that this presentation is for informational purposes only and should not be considered financial advice. While we are financial advisors, that doesn't mean we are your financial advisor. So if you are curious and want to discuss how Arbor Digital can help you or your firm engage with this emerging asset class, please visit us at our website, www.arbordigital.io, or you can reach us at any of our socials. So for those who are engaging with us for the very first time, I think it's important to highlight who Arbor Digital is. So Matt, could you briefly go over who Arbor Digital is?
Yeah, so Arbor Digital is a division of Arbor Capital Management, and Arbor Capital is based in Anchorage, Alaska. But this call and this quarterly update is specific to Arbor Digital, and our focus is on digital assets and managing a couple of portfolios of professionally managed digital assets. And part of the reason we have these calls is we believe education is really important. So that's why we're here, and that's who we are. And I should say, yeah, you just watched the intro, so you know who I am. I guess I don't need to say that, sorry.
All good. And yes, a really quick overview of what we're going to cover for the next 20 minutes, you and I, Matt, not with the broader team who everyone just met, but real quick. So the first thing we're going to do is we're going to go over kind of some of the external factors and what's affecting digital asset markets. And then we're going to go to some of the internal factors and what's affecting digital asset markets internally. The next piece after that will be the regulatory landscape. Then we're going to go into a portfolio update about our 2 SMA portfolios that we manage. And then we're going to go ahead and look ahead to Q3 and Q4, the second half of 2022. So with that, let's go right into the macro backdrop. Matt, I'd love to kind of engage with you. We just hit the highest CPI numbers in 40-year hit in the last 40 years at 9.1%. What's going on?
Yeah, pretty incredible. So it's not surprising. I think a lot of folks, especially in the digital asset space, have been talking about the coming inflation with some of the Fed actions. And so now we're just seeing it manifest itself. And like you said, Mark, and this chart shows us it's the highest print in literally a generation, which is quite interesting. So people like myself, I was like 5 years old, in the 70s and 80s. So I don't really remember it. I don't have any context. So this is all new, even for me. Now, obviously, some of my parents and folks like that have experienced this type of inflationary environment before, but it's pretty incredible to see this starting to manifest here in the United States. Now, there's a lot of interesting things with the dollar being the world's reserve currency. There's certainly appetite for dollars outside of the US, which is more distributed than it was back in the 70s and 80s. So that could be a factor in potentially helping the Fed do its job here, which is kind of controlling inflation. Because I try to think like everybody's like saying, oh, there's a recession coming, inflation is going to keep going up. Okay, that's true, but that's going to stop at some point. And so how could that potentially be paused or and reversed. And so, but yeah, it's pretty incredible to see that happen. You know, if we were kind of bumping along literally since the financial crisis, 0809, where you see that dip where we went into deflation in 2008, 2009, and pretty low to moderate, low to zero inflation for the next 12 to 14 years. Now all of a sudden it's just manifesting itself.
Yeah, and we're going to see that manifest itself, and we're going to see the Fed continue to start tightening as opposed to easing. That I think probably alludes to what you were mentioning. So what that's been doing for digital asset market, it's been the driver, right? We're seeing a lot of risk-off behavior of not just digital assets, but any tech firms in the public equity space. You see Netflix and a lot of the darlings being hit pretty hard, and especially Coinbase. Coinbase is a stock that's been hit, and I think they're 80+% off their all-time highs. After they went public. So we're not just seeing this in the digital asset space, but this has kind of been a main driver. And then obviously you have your other geopolitical events, right? You got Russia's continued invasion of Ukraine. You have COVID-19 shutdown still happening over in China. And then, as you mentioned so aptly, recession fears are, at the front of people's minds.
Yeah. And that's interesting. The recession fears that when everybody's saying something's going to happen, I'm like, okay, well, if everybody's expecting it, then maybe something else will happen. But back to the other reason it's important to highlight inflation in the context of digital assets, particularly with Bitcoin, right, is it has been billed as one of its use cases it's kind of inflation proof, right? It's built into the mechanisms of its supply. And so the great monetary inflation thesis that was written by Paul Tudor Jones a couple of years ago really was at the heart of that thesis was Bitcoin's ability to be kind of inflation proof over time. And so, and even, MicroStrategy and what they were doing, it was all about helping them combat inflation. Whether it's worked out or not, that, the jury's out, and we'll talk more about that a little bit later.
Yeah, absolutely. I think definitely the macro backdrop. One thing we highlighted in one of our recent weekly newsletters that we put out to our clients is that this is the first time digital assets are going through a macro backdrop like this. And I think that gets lost in in thinking historically about digital assets. And so a lot of what's to come, we don't know, because this is going to be a true test of the digital asset markets with this, truly uncertain macro backdrop. So
right, and you look at this 50-year chart, Mark, right? And Bitcoin was launched literally in 2000, right at the main dip there, right, on the inflation. 2008, 2009 is when it started trading. So the whole asset class really has never experienced anything like this.
Exactly. And so that's where one of the things that I know we talk about a lot internally is that we have to make sure we pay attention very closely to what data is going to tell us. Not just the lagging indicators, but we have to really pay attention in the moment what's happening. And that's one of the cool things about this asset class is you kind of see how things happen in real time with on-chain data. So I think it's a good setup. That's the first piece, is really setting up that macro backdrop. So I kind of want to go now into more of the internal factors. And the first thing we'd like to start off with is kind of reviewing some of the high level numbers within the digital asset market. So as you can see here, we're at around 950 billion in total digital asset market cap. So you can see here, I have the dominance numbers below, where Bitcoin is 40% of that, roughly around. Obviously, things fluctuate pretty quickly in digital assets, but you can see that Ethereum is about 15%. And we actually pay very close attention to stablecoins. So we're always monitoring what stablecoins are doing and what behaviors we see investors and how they're interacting with stablecoins, what they're being used for, especially in all the different networks, the on and off ramps from the crypto rails to the traditional rails. We love seeing what's going on there, and it gives us a lot of insight as to how these markets are evolving. So we like to pay attention to that. So we thought it'd be important to do that. And then
Mark, if I can jump in real quick, a quick anecdote to the stable coins is, the ones that are linked to the dollar, the US dollar. I think it's really fascinating where you see people in other parts of the world that can't access regular, hard US dollar currencies. They're using stablecoin dollar as a proxy for access,
Mhm.
because it's still viewed that whether we know it or like it, despite the inflation numbers, right?
Mhm.
The US dollar is still viewed as the safest and most secure currency in the world, and the stable coins just are another way for people that don't necessarily have access to that, to the hard dollar, to, I say that tongue in cheek, hard dollar, to get, but it's, they're having a proxy for it using stable coins, which I think is quite interesting.
Yeah, and that's an important thing to highlight. And I think it goes into also something that we are seeing is that while we've seen a lot of price depression over the last quarter, it definitely helped shaped Q2 was this broader market sell-off. We're going to go into a little bit internally, kind of the catalyst for that. But you didn't see a flee out of the crypto or the digital asset space. You really saw these dollar-backed stablecoins. A lot of the value has flown into safety within the ecosystem itself, which I think is one of the things that points to a healthier market than past depressions we've gone through, such as 2018 or even the ones before that. Is the flight to safety isn't happening outside of it; it's happening to the safety within the crypto markets. And so that's why we purposely put the stablecoin market cap here. If you take all stablecoins, it's about 151 billion. And if you went back to 2018, and we show this as a difference as to, because that's the thing that everyone asks us is, what's the difference between this in 2018 and before? And one of the key pieces is that stablecoins, you probably had a couple billion, if that. And I couldn't find the data point, but it's significantly more. And I think that's an important piece to highlight for this flight to safety. And then on the right, you'll see here, we like to put up correlations. So we put up year-to-date correlations, and you can see that Bitcoin and Ethereum are pretty closely correlated, evenly correlated with the S&P as well as the NASDAQ. One of the narratives of the space is that, Bitcoin and digital assets are an uncorrelated asset. To where historically, as you can see below, that has been true. And I would actually say, because of the last year and a half, correlation has definitely gone up. So I think it's a narrative we have to pay close attention to. And I think a lot of people like to rely on this, even though more recently, in a risk-off environment, you're seeing digital assets more behave, and where everything goes risk-off, you're seeing correlations rise, just like every other risk asset.
Mark, you're spot on with that, right? When everything goes risk-off, including everything, right? Fixed income's down, bonds are down for the year, stocks are down for the year. Again, I think we've said this before, but it's important to reiterate, right? When it's risk-off, what is the most liquid asset that trades 24/7 that anybody can access globally? It's Bitcoin, right? And it's some of the digital assets. So if people need to liquidate things, that they're going to look there to their most liquid assets. Didn't say the most price stable, but certainly the most liquid, right? If you have a stock portfolio Friday, 4:00 New York, you're done. I mean, yeah, you can do after hours, which with far less liquidity, and potentially engage in some transactions, in other markets over the weekend. But no, this is it. This is why when risk off happens, these correlations, and it's good to point this out, have gone up this year, specifically because of the risk off.
Absolutely. And it's an important narrative to check yourself on and make sure that you're implementing purposefully and in a disciplined way.
Oh yeah, we're going to talk about how people get levered up and then have to unwind. So as Mark, you put the slide together to wind up, so I'll let you go. Sorry.
Exactly. And that leads us into our next step, is really to talk about what really shaped internally what happened in digital asset markets. So what we'd like to do is present this as, set the stage first, and then for the wind up, if you will, and then we'll go into kind of how that played into the unwinding that we've been experiencing since early May. So to set the stage, the first thing you can see here, and again, this is a very high level, basic overview. If you want the finer details on these specific pieces, please go to our website. We do a weekly newsletter where we've gone over each and every one of these events. We've actually released some podcast episodes as well. So please engage us, that's there. But on a very high level, since late 2021, you'll see here on the left, you're going to see Terra Luna and Anchor. An Anchor protocol, which is an application built on top of the Terra blockchain, was offering 20% fixed yield on their native algorithmic stablecoin UST, which was meant to be pegged 1-to-1 with the US dollar. Now, the big difference between other dollar-backed stablecoins, as Matt mentioned before, is that it's an algorithmic mechanism to where they use Luna as a burning mechanism to help keep that peg with UST and the dollar. And then also it is uncollateralized, meaning there is nothing backing that stable coin. Again, a huge difference. And this was very much an experiment.
Yeah, it's important to say not all stable coins are created equal, right? Some are under collateralized or no collateralized, or even what I would, I think what we consider kind of experimental, where you're using some other Luna asset that could be, sold to support the price of, the peg to the dollar. And so having where you've got maker and DAI, very different mechanisms in place that have been functioning, quite well for like 4 or 5 years. Not all stablecoins are created equal, and this was definitely in the experimental camp. And algorithmic stablecoin that was pretty much untested, and then it's hard to use the word exploited, because if when there's liquidity issues and people want to rush for an exit, and it's never orderly, and things can just go bad, and that's exactly what happened here with Terra Luna and UST.
Yeah, we'll kind of get into the other pieces too, however that is. But yeah, thanks Matt for jumping in with that piece. But it's a very important piece. That's the first block that we have to set up. And then the second piece you hear is Lido and staked ETH. So if you've never heard of those things, again, I encourage you to go check back some of the resources. We have a written piece also with this video on demand. So please go check out those pieces if you want the finer details. But on a high level, Lido is a decentralized finance application built on top of Ethereum, where you can tokenize Ethereum, the asset. And you may be asking yourself, isn't Ethereum already a token? Well, yes and no. Ethereum is more of I would say, a cryptocurrency or a utility token. And that's where Lido took advantage of staking ETH to allow holders of Ethereum who are staking their ETH for the upcoming merger to Ethereum 2.0 to actually unlock that value while that ETH is locked up. So they can use it as collateral to borrow, so on and so forth. And that's the high level thing you need to know there. Now, the next piece is understanding Celsius, Three Arrows Capital, and other centralized entities like Voyager and Genesis. So what these centralized entities were doing, again, very clear, and we'll make a distinction of this later, is the difference between a centralized entity and a decentralized entity in finance here. These centralized finance entities levered up with those positions in staked ETH as well as Luna and UST. And what they also did was a thing called bridging, where they would transport some staked ETH to the Luna or the Terra ecosystem and then stake it on UST. And this was a way in how they were generating all of those yields that you would see on their platform. So when you saw BlockFi or Voyager or Genesis offering some of those yields within their applications, 8, 9, 10, 12%, whatever the case was, this is how they were doing it. They were generating this 20% fixed income generated yield in the Luna Terra ecosystem. And then the staked ETH was also generating its own yields. They were kind of doing a lot of these trades, and then they would lever up those positions to generate more. So that's an important piece to understand what they were doing. And that also, contributed to the numbers going up as we were in the bull market. And then the last piece to understand is, and we already talked about this, the lending piece now. You had these lenders, so Voyager, BlockFi, or Celsius, they were going out and then lending assets to hedge funds and other asset managers like Three Arrows Capital for them to be able to lever up and increase their positions, and again, increase their AUM, which is again a lot of times how they earn a lot of fees. So that's kind of the stage and the setup. Matt, anything else you want to add to that setup? Was there anything I missed?
No, I think you did a great job. Yeah, just the way that some of these funds had, and there's other counterparties, right, to who lent them money, right? These guys were putting, these people are putting assets into these protocols and doing bridges, but they were also borrowing money from other centralized institutions, which are now at risk as well, because when you loan the money and contribute to this levered up issue, it causes problems for everybody.
Exactly, and that's a great segue into the unwinding.
Mm-hmm.
So the first domino that fell was the risk-off macro environment, which caused an initial price drawdown in the digital asset markets. That's what initially sent the Terra and UST, or Luna and UST, into their death spiral of that algorithmic stablecoin. And so you just saw that unwind. It unwinds so fast. And then the second piece that to understand about the wind down was that this staked ETH that was bridged to the Terra ecosystem caused that initial liquidity crunch when that death spiral happened. So you have a lot of the collateral that was being used by Celsius and 3 Arrows Capital and these other players that we know now that was being used was that was what caused that initial liquidity crunch. And it was, this over leveraged trading done by these firms that led to this unwinding. And, in the end, they were unable to recover. And then you saw Celsius and 3 Arrows Capital, which now you've seen have all become insolvent. 3 Arrows Capital, you actually couldn't get to anybody at the firm. And so people were very much wondering what's going on. Can anything be recovered from 3 Arrows Capital? And recently, as of July 13th, Celsius actually filed for Chapter 11 bankruptcy, which is a key part. And we're going to talk a little bit kind of what happened even before that to showcase kind of some of the silver lining. But what that unwind then led to is these lenders that lent to Celsius, 3 Arrows Capital, and these other funds. Now, because they can't meet those obligations, these centralized players are now in trouble because they lent out so much to these players. And that's why you're seeing Voyager and these other players filing for a bankruptcy. And because this is the only way that they can get to anything. Now, there are broader plans that are happening there. And again, if you want those finer details, you can go into those recovery plans in some of these other write-ups that we have. But that's the gist, and that's a high level overview of kind of what that unwinding looked and felt like.
And yeah, I would make the comparison, Mark, to the 2008 financial crisis. It's, when banks and everybody levered up and bought mortgages and then offloaded a lot of that risk to Freddie and Fannie, they didn't have to deal with it. And then all of a sudden asset prices started coming down, and all of the derivatives and everything that were tied to the prices of that unwound very quickly. The main difference is there's no Fed to come in and back up these companies, right? Or the US Treasury and the federal government, right? They're not going to step in and bail out these folks for taking on risks. But to me, it felt and looked a lot like that. It was just happened a lot faster, and it's on, some of this is centralized, some of this is on chain, and it happens where technology enabled this unwinding to happen much quicker. If you remember the 2008 financial crisis, it drug on for a couple of years. This happened in, a couple of months.
Yeah, very well said. And I think the key part to understand is, especially when we talk about these lenders who lent off, now they are starting to pay off these loans so that way they can file for their bankruptcy and these recovery plans. An important piece is they have to pay off their DeFi loans. They locked up collateral in these DeFi protocols. So even though they were centralized finance players, the way they were generating the yields was taking deposits and then going into decentralized finance. And so why is it important? Why are we mentioning this? Because it really leads into the silver linings of how all of this played out. And I think the first one to really highlight is that in the face of insolvency of these centralized entities, they think about the capital stack. They had to pay the DeFi protocols first. And I think that you're going to see, you won't probably see this a lot. And I think one of the things that's misunderstood by the headlines is you'll see some headlines say that DeFi failed or decentralized finance. This is a case study for decentralized finance and why it's going to fail. And I would say that is completely wrong. And actually, it's on the flip side. Decentralized finance did exactly what it was built to do. And actually, they were paid first in the capital stack. It was the centralized entities that were actually left kind of holding the bag. And in turn, it was a lot of individual investors that trusted a lot of these centralized entities. And the thing I think is important is the transparency of these centralized entities. We can't go see their order books, like you can go on a DeFi protocol. The users, have to wait for this payout with no guarantee. And while these DeFi protocols are recouping 100% of these loans that Celsius took out, I think Celsius had loans to Aave and Maker that they had, and they were fully paid off. And as a quick disclosure, we do hold both Aave and Maker in our Compass portfolio. But I think the thing is, is, who forced them to pay? Was it a lawmaker? Were there attorneys? Were there courts that said you have to pay back these DeFi protocols? No, it was the smart contracts. It was the code,
Right.
right?
It's really important to Mark that you mentioned that. I'll add on, right? The smart contract is code and it's technology. It doesn't care if you want to release your collateral, you have to pay it back. It doesn't care if you're a government or if you're an individual or an institution or somebody with $18 billion, right? That can influence and have political capital to throw around. You pay it off, that's it. And then it gets unlocked. And to your point, there's no backroom deals getting done behind the scenes. It's like, hey, your assets or your collateral is locked in a smart contract. Here's what you need to unlock it. Mm-hmm. It's not a favor. It's not anything else. It's not a political whim or anything. It's just, here's what needs to happen. And then the code recognizes that and then unlocks it. And that's beautiful and it's transparent. And that is where, I think you and me, and there's a lot of folks that are trying to create this narrative around why DeFi works. Mm-hmm. Because what happens in the traditional media is it gets, DeFi failed. Terra Luna, which definitely experimental failed and it did, but DeFi and the true protocols that are battle tested and been around a long time that have really, really strong smart contracts and codes and good governance, they're the ones that performed flawlessly through all of this.
And I think it's an important piece to understand that even though the digital asset markets did this drawdown and you had people getting liquidated, even though those loans were liquidated, the DeFi protocols were made whole. Very powerful. There are so many implications to everything that's happened in the use case for DeFi. And this is why traditional finance professionals like us on this call, and then who have made the leap from their traditional roles to DeFi, get excited because they can see these things. Because when you make, and I think some of the rumors that were happening around, and again, these are purely rumors, but you maybe had some similar behaviors. You mentioned the 2008 financial crisis, Matt, and we've even seen in traditional finance, other, asset managers who have used the same collateral to lever up and go to different entities. And they never told these other entities what they were doing and they were using the same exact collateral to get the same funding back. And that's a huge problem. And with DeFi, you can't do that. Once you lock that collateral up, you can't go to another protocol and then use the same collateral, right? And again, I think the case though that we would push back on that a little bit is this idea of staked ETH, where you stake Ethereum and then you have the staked ETH. What stops you then from staking the staked ETH and then going out and re-tokenizing? And I think that's where there's some things with liquidity pools, and obviously you have to have a market and you have to make a market for it. And I think there are a lot of barriers to that. But
Mark, that gets into the second bullet point of risk management. Is as great as all the protocols, the DeFi protocols are, right? There's still basic risk management that needs to happen. And Maker is a great example because they have typically over collateralized loans and they have different levels set for that. But there's, you can make a case of how that could potentially go wrong if the underlying asset prices are moving really fast. I mean, there is risk. I don't want to make it sound like the DeFi protocols have no risk, but they perform a very, very efficient function without political influence and without backroom deals. And it's pretty clean. Here's what you need to unlock the collateral. You can either unlock it or we'll liquidate it when it's necessary if it comes to that. So
and I think I think if you're listening to this, I think my biggest takeaway was look at the behaviors that DeFi is incentivizing of these players. So there's two spectrums of that. One is in the case of crisis, these behaviors, this actually incentivizes people not to go out and do these bad things and commit bad behaviors. And that's, I think, is very, very powerful if you're talking about a long-term healthy financial system that you want, to power, society. And then I think on the other side of the spectrum, that also does lend itself to making sure that you have these risk management techniques in place for this new type of system. And that's kind of the standards that still need to be built. And that's where to showcase that there is still a large amount of risk within these markets. So while it's great that things operated well in the DeFi space, it is important that there is still a lot of experimentation. And this is just one of the learnings. This is one of the ways that will create, defensibility within the markets. And so just kind of rolling down here, I think the other thing that we're seeing, the silver lining is, you have these opportunity for these well-capitalized and, these firms that did practice good risk management. So FDX is a great example that we've seen. And CEO Sam Bankman-Fried, he's going in and kind of being the modern day JP Morgan, if you will, and almost bailing out some of these centralized players. But yeah, I think even after looking at some of the balance sheets, they're saying no. So it'll be interesting to see. And I think one of the silver linings is you're going to see a lot of the people who are doing good risk management and practicing good behaviors are going to come in and take these other, distressed assets and maybe buy them, and then they'll be able to put out things better. And it'll be a washing out of those, which is definitely needed in the space. We want to make sure we go through that. And while it's going to be painful in the short term from a price standpoint, for the long-term health of the digital asset markets, we feel that this is very, very important.
Yeah, absolutely. And part of a lot of the things that we're talking about, a lot of this, I feel, was driven somewhat by institutional FOMO, people just trying to throw billions of dollars to get some sort of exposure to digital assets, because let's be honest, it's hard to find and to do the work to find, an appropriate regulated channel to onboard assets is not that easy. And we're going to talk a little bit about regulation, but that's where I view a lot of this. It's people just throwing billions of dollars at this, trying to do something and getting enticed by yields, and then over leveraging. And then obviously whenever you over leverage, it doesn't matter the asset, let alone one of the most volatile assets ever, you're going to have washout. And that's exactly what you're doing. And you just mentioned that, Mark, like, we want this, let's wash this stuff out. Let's get this garbage out, get these funds that levered up out of the system, get their money out. And then let's continue just head down building the next, financial institutions.
Well said. So let's dive in, because I think this last bullet point is, we do feel that from what's happened, you're going to see accelerated regulation, or at least we hope so, if they're paying attention. So I'd like to go through just a couple of highlights and then go into kind of what we feel is going to be one of the major things to be playing out within digital asset markets moving forward. So first is, in this past quarter, you had Senators Kirsten Gillibrand and Cynthia Lummis introduced the Responsible Financial Innovation Act. So that's their effort to create this complete regulatory framework for digital assets to encourage this the responsible financial innovation. They're looking for transparency. They want to put consumer protections, and they want to integrate digital assets into existing law, not try to make existing law change exactly what digital assets are. And so while it's exciting to see that come through, we definitely don't think anything will come from this until early next year, mid next year, because I think there's a lot politically that's happening within the U.S. And then also within the U.S., you had SEC Chair Gary Gensler proposing a one rule book approach, and what all that basically means is that he wants the SEC, in coordination with the Commodities Futures Trading Commission, the CFTC, and bank regulators, to have one rule book, as opposed to everyone kind of ruling over and having different books within their different regulatory bodies. They feel this is the best, and that he feels this is the best way to guard investors against market manipulation, fraud, front running, all the things that that are in their mandate. And I think what you're going to find that upcoming in Q3, or specifically in September and October, many of the reports that were required from the recent White House executive order that came in Q2 is going to come in those months. And so we're going to be eagerly looking at those findings. And we have a link to the full schedule in our written piece that is going to supplement this video. So make sure to go look at that. I know NYDIG has released some things. I know a lot of people have those schedules out, but we're going to put the link to the White House website. But Matt, anything there? Because you're a compliance officer. Anything there? I know we've done a podcast recently on a regulatory update, but anything you'd add for U.S. regulation?
Yeah, just real quick. Yeah, we had a podcast that I did with Planner Dow about the executive order, and we just did another one a couple of weeks ago about the Responsible Innovation Act from Gillibrand Lummis. I think what's important, and what to highlight at the top level, is that our government in the United States there's this sense now that we're not going to ban this, right? We're going to try to find a way. The government is and the regulators are recognizing the potential for the innovation of a decentralized financial system, and they're trying to create opportunities to allow this innovation to flourish. And I think that's a really important shift that we've seen in the last year, as opposed to prior administrations and prior government people just kind of saying, well, we're not going to support it. We're not even really going to, we don't really like it. And so that's a really important shift in the tone from the US government. And we're following all of these very closely. I'm a compliance officer. I'm involved with the compliance and legal subgroup of Planner DAO. And, so we're always, if you want more resources there, we can provide, want more information there, we can provide links to some of those resources as well. But that's kind of my biggest thing is I'm excited and encouraged because I've been in this space a long time, and, it's gone from, this is just for drug dealers and terrorists. Now we finally have the US government at the highest levels stepping in and saying, okay, we need to, this is real. There's something here, and we need to help not only protect investors and punish the bad actors. I think that definitely needs to happen, but create this level of, a level of innovation for people to go out and experiment with digital assets and blockchain technologies.
Wonderful. And I think it's an important thing not to forget that this is a global asset class.
Yep.
So when you're investing, this isn't just US centric. And I think a lot of times, especially US asset managers, we tend to, get our home biases cooking when it comes to regulatory landscape. So we thought it'd be important to highlight some of the regulatory progression we're seeing in other jurisdictions across the world. So just a few examples, and we have a broader list, and again, in that written up piece supplementing this video. So a few highlights. So Japan's Financial Services Agency passed legislation that defines stablecoins as digital currency. Very, very important. So what this does is it imposes a mandatory link with the yen and the right to redeem them at face value. And so again, what that means is that the issuance of these stablecoins will be restricted to banks, trust companies, and certain licensed money transfer agents. So again, very important piece of legislation over in Japan. And then over in Australia, you have the consumer protection oriented legislation to set up crypto related issues within this proposed Digital Services Act. And what the act is expected to cover is licensing, custody, taxes, debanking, and decentralized autonomous organizations, or DAOs. So we're excited to see what's going on and how that's going to progress over there with that Digital Services Act. And then you have the European Central Bank, the president, Christine Lagarde. She recently suggested she wants a separate framework for crypto asset staking and lending. So in addition to, I think they had another piece of the markets in crypto assets regulation that they had in the works. And they're expecting to finalize that towards the end of July. I think it was June they were aiming for that, but because they have their own concerns about risks of fraud, illegitimate valuation claims, which is a hot topic in the asset management space, is valuation analysis, and speculation, criminal elements, all the stuff that we've kind of mentioned before. But I think this dovetails into the biggest events to unfold over the past quarter is what happened earlier, or actually more towards the end of this quarter, which is the SEC's decision to reject both Grayscale and Bitwise's applications for a spot Bitcoin ETF. And they stated in their response that market manipulation was their primary concerns. And Grayscale subsequently filed a lawsuit against the SEC after they received their rejection. So for those of you who are new to the space, Grayscale's flagship product, the Grayscale Bitcoin Trust, the largest Bitcoin trust for investors, and has been the main avenue for which investors over the last 5-6 years to gain Bitcoin exposure. And again, disclosure, Arbor Capital Management does have a position in GBTC and utilizes it as a vehicle for traditional clients. The GBTC reached an AUM of about 43 billion at its peak in the height back in November 2021, with a current AUM of about 13 billion. So their goal was to convert this product into a spot ETF. And so that was their application to the SEC. And that was what the SEC rejected. So the Grayscale feels that the SEC's position is inconsistent with previous decisions. The SEC has gone ahead and approved other Bitcoin-based ETFs, like the futures-based ETF, or they've got an ETF to where investors can now short Bitcoin, which again, fine, that's great. But they feel that decision doesn't align with their mandate to protect investors. If you're going to approve those ETFs, but you're going to decline something that's already existing. We have this product where investors are already in, and you're going to decline this spot Bitcoin ETF or this conversion of our GBTC. And so, Matt, I'd love to know your thoughts, because I think you have this line that I always have to go into around, how a lot of the what is it? A lot of the legislation, or a lot of the rules that are going to be made when it comes to digital assets, they're not going to be settled from legislation. They're going to be settled in the courts. So tell us what you mean by that, and kind of go into that a little bit more.
Yeah, yeah. I always go back, Mark. I know we were talking about this before the call, like the Howey test, right? The Howey test still stands to this day as the definition of, the four-prong test to define a security. And that was from what, the 30s. And it wasn't something that the SEC or any regulatory body came up with. It resulted because of a lawsuit between the SEC and the individual that was bringing the suit against them. So the point there is, like, if we're going to sit and wait for the SEC to offer clear regulatory guidance on this, I think we're just going to be waiting forever. And I think based on all of the rejections of spot Bitcoin ETFs over the last 5-10 years, however long it's been, it's going to have to come to the court. So when Grayscale announced this lawsuit, I was happy, because I think we'll finally get some clarity from this. Now, to the SEC's point, there is some jurisdictional differences and concerns that need to be aired out. And it'd be nice if they would, help provide solutions, but I think the courts are going to do it. And what I mean by that is, Mark, you mentioned the futures approved ETFs in the US, right? Those futures are traded on the Chicago Mercantile Exchange, which is a regulated entity. And the CME has done a great job. Full disclosure, Arbor also owns shares in the CME group. But they've been trading Bitcoin and Ethereum, for almost 5 years, been trading Bitcoin futures. And those price mechanisms provide the framework for a lot of the for the futures ETFs, right? The Bitcoin price is global, and, the SEC says can be manipulated. And yeah, it probably can be. And there's exchanges, in all over the world that help determine the price. And that's where, to me, it comes down to some jurisdictional issues that the SEC doesn't feel like they can control, and they can't, because it's outside the border of the US. So all that being said, I'm happy that Grayscale has done this. I think on some other calls, I said I was disappointed a couple of years ago, or 18 months, this industry moves so quick, Mark, when Coinbase was trying to launch their lending product, and they decided to shut it down because the SEC was telling them, we're not going to, they gave them a Wells notice, and they're going to kind of like make it really difficult for them to launch this. And I was hoping Coinbase would then challenge the SEC and sue them, but they did not. Mm-hmm. And so this is kind of one of the first big showcases. I don't want to say battles, but it will be. But it's a good time for the industry to step up and showcase, why there's market demand for this, right? I mean, people and investors want access to this asset class, which is why we exist at Arbor Digital. But importantly, like creating safe products, that's what the SEC should be doing. And I hope the result of this lawsuit is that we get movement in the right direction.
Yeah, that's well said.
There's a lot there. Sorry.
No, that's good. Thank you for going into all that. It's, again, you're the one who spends most of your time, or not most of it, but a lot of your time in these areas, and where I don't. So I think for me, and I think a lot of the questions that I get asked by other professionals, investors, you name it, institutions, is, the Bitcoin ETF. And I think what this does is, things in the courts, when they get settled there, they don't happen quickly. So while crypto moves quickly, I don't think this is going to move quickly. So for those of you who are anticipating a Bitcoin ETF in 2022, or maybe even 2023, I'd probably have to say the probability is continuing to drop with these types of things. And I would say 2022 is a very high probability no Bitcoin spot ETF.
Yeah, that'd be
I don't think I'm being controversial in that statement.
And as Rick Edelman always says, it's 18 months. We'll get a Bitcoin ETF in 18 months. He's been saying that for like 5 years. So 18 months from now, maybe. So that puts us into 2024.
Yep. And we'd probably be close to that timeline. So what we'd like to do now is kind of go into some of our portfolio updates. So we've gone a little bit about the markets themselves. Let's talk a little bit about Arbor Digital and our portfolio. So Matt, I'd like you to spend very quickly talking a little bit, because we've been purposeful with how we manage and the type of vehicle that we've brought to the world, and what we feel is doing in investors' best interest. So can you talk a little bit about some of these points? I'd like you to kind of kick it off with, why did we do an SMA? Why didn't we just go out and do a fund?
Yeah, that's a good question. We wanted to provide as direct exposure as possible to the underlying asset for our clients, right? And so we, as you mentioned before, we have owned GBTC, which is in my opinion a little bit of an imperfect vehicle, which is why they're trying to get it converted to an ETF, because it trades at huge premiums and discounts, as well as some of their other products that start trading on the secondary markets, the ETH. ETHE and some of these other ones. And so when I was looking for solutions, we said, well, let's go find a place where we can actually give our clients as direct exposure as we possibly can in this regulated environment. So that was a big reason why we partnered with Gemini, and they are the custodian exchange for our clients' assets. And then the other thing that's really important is we've got a couple of these bullet points up here is, we don't lever up, right? We are not, taking on a ton of risk and then FOMOing into something, right? We've been thoughtful. We've been building this over the last, we started in 2018. So we are taking the gradual right approach as fiduciaries of safekeeping our clients' assets as best we can in this environment. And that's the reason we've created Arbor Digital, to be honest, right? That's it. That's why we're here. Staking and yielding, we've talked about in the past of how we can responsibly engage, and we haven't done any of that yet for our clients because there's a lot of additional regulatory concerns around that. So right now, no, we're not engaged with staking and yielding. We're not borrowing money, we're not engaging in some of these behaviors that have led to this massive unwinding that we've just been through.
Yeah, and I appreciate you going through that because I think it's something that's really been important to us is, how do we safely and securely help clients navigate this? And, whether we do it or not, I think what we've learned is that a lot of individuals are going to go engage with these markets themselves if their advisor is unwilling to help them. So we know that we wanted to have a solution so that way we can be that fiduciary for them and help them do this safer than if they just didn't have the time to, because that's our commitment, is that we spend all of our time in this space, and me specifically, so that way we can help our clients safely engage with this asset class. And then we can help them, to where they're not making poor decisions, getting in at the wrong times, and again, you can't time any markets perfectly, and we don't claim to, because no one can. But I think it's important to highlight that we have an investment thesis that has been established and evolving since, you mentioned 2018. And, that hasn't been broken. Network effects, Lindy, Metcalfe's law, all of those still apply to the networks, and how we believe these assets are going to evolve over time. So we're not going to change this approach. So it's important to let investors know that. So I think I'd like to highlight just the two different portfolios that we do have. And the first one is we call it our flagship. That's pretty much your market portfolio, your beta portfolio, if you will. And, it's an exposure to an actively managed balance between the two biggest digital assets that make up a large portion, over 60% or upwards of 60% of the digital asset markets. And we feel that's still a good proxy of a market exposure. And then we go into our second portfolio, which is our Compass portfolio. And that is your early to mid-stage publicly traded decentralized blockchain opportunities. And I really hesitate to say they're mid-stage, right? A lot of these protocols are still in the first couple or to few years of existence. So can you really call something mid-stage there? And I think, some of them are really displaying a lot of resiliency in here. We've already mentioned a couple with Aave and Maker.
Oh, yeah, Mark, it's fair to say that. I mean, some of these protocols have been around for several, 4 to 5 years. They're some of the first ones deployed on a layer 2 on Ethereum. So yeah, but yeah, to your point, there's a lot of brand new ones, and we're seeing some get washed out that weren't properly decentralized.
Absolutely. So just a quick highlight of the year-to-date performance numbers then of both. We wanted to go through Bitcoin, Ethereum, and then flagship, which is that market portfolio we just mentioned, and then that mid to early stage investment. It's been really interesting to see, how we've managed. When we go into that Compass, it's a larger risk. We're definitely going way further out on the risk curve, and I think it's been really interesting to manage these types of assets because normally, it's very different than VC style investing, where you're actively managing in this space. So it's been really fun to learn and apply what we learn in the standards that we're helping develop. So while all digital asset markets are going, we're pretty much in line with some of the indexes, like the Bitwise 10, And we should probably put some more numbers around that. But this is kind of how we're performing so far this year, with Bitcoin being down roughly. And again, this probably is wrong by the time we release this content. But as of June 30th, 2022, at the end of Q2, Bitcoin was down roughly 57%. You had Ethereum down 73%. Our flagship portfolio, which is that blend between the two, is performing just as you probably expected. We have a little bit over allocation to ETH right now. Not financial advice, but that's just our approach. With that's down 66%. And then with our Compass, that early to mid stage portfolio, down roughly 73%. And I think this dovetails into the question we get asked the most, which is, are we at the bottom? Should we be getting in? Is something inherently wrong? Is crypto going to zero? So to answer all of those questions, I'm going to do a very high level, and we use many different metrics here at Arbor Digital, both on-chain and off-chain. I recently wrote in one of our weekly newsletters about some of the on-chain metrics that we use to determine whether the digital asset markets are overheated or if they're in value territory. So I've decided to put one chart you can see up here now, which is where, based on many of those metrics, so such as MVRVC score, or net unrealized profit and loss, or net value transaction ratios, we can see in a lot of the historic measures that we've used that we are very much towards the bottom. And we can say with a high conviction that while we don't know if we're at the full bottom yet, we are very close to it. And so I'd hesitate to say that we are at the bottom, but now is the time where you should be developing a long-term investment strategy, which is, again, what we do. And we mentioned earlier, we're not traders, to establish these long-term positions. And I think this goes into, just how we are navigating. So what we're doing within our portfolios is we're going to keep investing in our highest conviction networks. So what does that mean? If you're a current client, you're probably going to see some rebalancing towards some of those higher conviction networks. We may put a lower balance, and that's another way we can risk manage is our weightings towards these assets. So we're going to do that, and we have our highest conviction assets that we're going to make sure that get the weightings properly. We're going to keep a disciplined approach to dollar cost averaging. Again, we don't try to time the markets, but we use our data to help us decide on risky versus low risk buy zones for assets that come onto the platform, or I should say cash that comes onto the platform. And then one of our main value adds is that we're going to help clients stay disciplined from a behavior standpoint, right? I think a lot of clients who aped in, when everything was trending at the highest, or who are basically chasing the returns, we've actually helped clients protect against getting in at those highs, and we've had that disciplined approach. And I think the last piece is just integral to our DNA, which is educate, educate, educate. So if you're a client, or if you're not a client and you need help educating, whether it's your internal teams or whether it's individual clients, we have a lot of resources and partnerships that we use to help deliver high quality content that go way past just behavioral headlines or the emotions of the markets, and talk more about what's happening behind the scenes. Matt, anything else you'd like to add there, and kind of how we're navigating these markets?
No, I think you summed it up well, Mark.
Wonderful. So I'd like to kind of do this now, just spend a minute doing a couple ending thoughts. And I think for me, a couple things we're going to be paying attention to is some of those pieces that led to the unwinding. We're going to pay attention to those. And I think one thing that we've learned, and what we saw a little bit already, but I think because of what happened, is this centralization, and specifically within staked ETH. Lido, which is the provider of that staked ETH solution, there's some market risk there still, where they are the main centralized player. But I think it also showcases the power of tokenization, because there are many other protocols that do offer tokenization services, but Lido is the one getting all of the staked ETH, and they have this offer. So they do have this competitive advantage. So it's like there's both this market risk that is still present, but kind of showcases some of the powers there. And I think there's going to be a need for other protocols to come and compete and have those tokenization services, specifically for that staked Ethereum. And I think what you're going to find that we're paying attention to, where I feel that a lot is going to happen, is you're not going to see a ton happen regulatory wise, but we're going to be paying attention to a lot of the language coming out of the SEC and these other governing entities across the world, because you still want to maintain that everything is headed in the right direction. But Matt, any ending thoughts you want to bring up here?
No, I would just say that the last thing I'd like to add, we've been invested in this asset class for a long time. We've seen these ups and downs, whether or not, it's a different reason for the unwinding, it doesn't matter, right? This is a very volatile asset class. But one thing that's consistent, we see the lows are much higher every time, right? There's a cycle that you talked about, Mark, right? With 10 years ago, Bitcoin had almost zero value, or back in 2012. And now it's just continued. I remember the first time I went through 100, and then 1,000, 10,000, and then 50, right? And then the lows come back down. My point being is this asset class is not going to go away, and it's here. And now is, with Bitcoin sitting around close to 21,000, we're well off the highs. And so as we get this washing out that's going to happen, and these protocols and the people like us that are building, products and tools for clients to engage with, now's the time to be, really rethinking how an allocation should look. And if you were believing it when it was at 50,000 Bitcoin, right, and it's at 21, like, our thesis hasn't changed. We're still going to be onboarding clients and telling people that this is an appropriate allocation for your portfolio.
Yes. And I think that dovetails into my last piece that I would leave everyone with, is that if you see a digital asset or crypto firm thriving in these down times, then that they've probably done a lot better job at managing risk. And those are the ones you want to pay attention to. Yeah. Arbor Digital being one of them. So last thing too, as we end off here, with everything that's gone on, we are actually partnering up with some of those firms who we actually are strategic partners with. So risk management in crypto, July 26th at 11 a.m. Eastern to 12 p.m. We are excited to work with CloudWall. Kyle over there, the CEO, is going to be joining us. And we have Doug Schwenk, CEO of Digital Asset Research, who has been an integral partner. And we want to thank FTSE Russell actually for putting this on and inviting us to come show how we're managing risk in these markets. So with that, Matt, thank you so much for doing this with me. It's been a pleasure. I hope you all enjoyed this digital asset quarterly market update. If you want to get in touch with us, please reach out to us via any of our socials. Reach out to us at our website, arbordigital.io. And until we meet again, thank you, and we'll see you soon. And be sure to tell someone today you care about them. Bye, everybody.
Bye, everybody.
We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
We are financial advisors. However, we are not your financial advisor, unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.